On today's show, why Wall Street giant Goldman Sachs is in the indexed annuity market. Part 4 of this week's series on the impact of QLAC and emerging insurance products in retirement with nationally recognized annuity expert Mike McLaughlin. Hi everyone, I'm Steve Savant, syndicated financial columnist and contributing author to Backroom Technician and Innsbruck. Let's get down to business. Well, welcome to the show, Mike.
It's great to be back.
I'm so happy. We're doing this whole first 3 days, Monday, Tuesday, Wednesday on QLAC was huge. Now we're talking about emerging insurance products, right, in our business. And I'm sorry to say, I'm in shock. Goldman Sachs in our business? Wow. Mike, let's take a look at this document that you have here. It's pretty cool. I mean, Goldman Sachs in our business. I'm still recovering.
Yeah, here in the fourth quarter of the year, we have unbelievable product innovation, probably not like I've seen in one quarter for several years. Part of the interest rate environment, a lot of different things coming to a perfect storm. A lot of people have been going after the Allianz Barclays Budbee Index. This is one of the great answers to it, and you're exactly right. We think that Goldman Sachs, a premier Wall Street firm, being inside the fixed index annuity business, I don't want to say legitimizes it because it was an already legitimate business, but certainly adds some value to being in our business at the same time.
Well, I think this is huge gravitas for us who are insurance professionals using really non-FINRA products. So this is a huge deal. Walk me through, why is this such a big deal and why does it answer Barclays, because that's a huge index itself?
Sure. Well, think about the Barclays. There's really only two different indices. You have the S&P 500 and then you have Lehman Brothers Aggregate, and they're all domestic here. The other thing here is with Goldman Sachs here, you have a U.S. equity, and it's a futures rolling index strategy. And then you have a blend of the European and Japanese equity rolling strategy, U.S. bonds, U.S. government bonds, international of European and Japanese. And then also you have some commodities here in terms of crude oil and gold. And then you also have a money market opportunity so that if things really get crazy in terms of volatility, more money can go to a money market and really be in a safe haven. So what this index provides is far more diversification than what you have with some of the other volatility controlled indices.
Now, when they made this allocation model, they cherry-picked out these side funds, these certain indices. What do you see in your big global idea? Now, does that make the caps higher on this product?
Well, actually, this is a kind of more of a participation type of pricing because of a combination of different things. First of all, you have a far more diverse indices, so things are a little bit more predictable because you're more diverse. You're looking at a different type of option strategy that is just above the risk-free rate, and so you're only buying options above the U.S. Treasury bill rate. So that makes that option pricing much more dependable. Today, as we talk today, the participation rate on the 7-year is 105% of this index, and on the 10-year chassis is 115% of the index.
Now, no dividends, but full participation above the line.
Full participation, exactly.
Wow. Well, let's just walk through that. I mean, this, when you look at this in some of our, comparing other products that we have online, is that the most, what I would say, most benevolent participation rate, especially with this kind of diversification? Absolutely,
because one, you have much more of a consistent pricing strategy or much more consistent diversified. You also have a leader in investment banking to be able to do those option pricings very efficiently.
These people at Goldman Sachs, they're in the market.
They do it every day.
They do it every day.
They are the market in some aspects.
Now, with this, how long has this been out right now?
This has just been out for really a couple weeks.
All right, so we're really new right now to this. What kind of activity have you seen?
We've seen a lot of interest. Just think about the people who have assets under management, who have mutual funds. Think about the volatility that has happened in the markets over the last 30 days. We've seen point swings of 25 to 300 points up and down. Already clients are starting to ring the phone. This is a great opportunity. Now, this index is actually a 3-year index. And in our mindset, we've been accustomed to the 1-year point-to-point strategy. But because of this unique diversification, think about, you've got a diverse part of mutual funds and an entire portfolio. What a great way to do this for 3 years during what might become a very volatile period. lock in so that you're not going to lose any money, but have 105% of this diversified portfolio.
Mike, let me ask you, they're the 36-month hold then, right? It's not point to point except for 1 to 36 months. What's the thinking behind that? Because most people are so used to the conventional annual point to point. Why does that work?
Well, for a couple of reasons. One, because you're going out a little bit longer, option pricing is a little bit less expensive. With a diversified strategy, diversified strategies are more dependable and more predictable over a 3-year period versus just a 1-year period. So those two things lend to a better pricing.
Well, when we come back, I want you to walk me through this so I can see the mechanics of it, because I think that'll help us and our advisors to really get a handle on this. We'll be right back after the commercial break. It's not how much money you make for your clients, it's how much money they get to keep, especially in retirement. But retirement income could cause Social Security benefits to be taxed. One tax advantage alternative is life insurance designed as a non-modified endowment contract that can generate tax-free income without taxing Social Security benefits. These contracts offer differing funding options depending upon your client's risk tolerance. For more information on how life insurance can be part of your retirement planning, just email me at steve@downtobusiness.tv. Brought to you by Ash Brokerage, the practice enhancement company. Well, welcome back to the second segment, of course, with nationally recognized annuity expert Mike McLaughlin. Mike, you're walking us through Goldman Sachs is in our business. Wow, it's really huge. Walk me through the mechanics, because I think there's a little bit of queasiness from some of our advisors about the 36-month hold position, the annual point-to-point. Walk me through why this may work out, though.
Well, one is, I think that, again, what you talked about in the previous segment, option pricing is a little bit more dependable, so you get a better and more consistent renewal rate down the road. Now, this is within Western and Southern, and Western and Southern has a great track record of renewal rates on their fixed industry, or on their fixed accounts. This is the first time that they've done a fixed index annuity, so they partnered with a high-quality investment bank that can provide dependable renewal rates down the road. The other thing is our industry used to say zero is your hero. This is an index that historically, when they have back tested the index and the combination of the index and the algorithms, that we've not had a negative year, so that your client won't see a zero at the end of the 3-year period. The worst 3-year period has been about 5.7, so that comes out to be what, about 1.75 or something like that.
Wasn't this back tested in the word like the lost decade?
Yeah, actually look at here in terms of 07 through 10. Actually turned out a 6% rate of return, and then in the 1 year before that and after that was 6.5 and 5.7. So in the worst economic time frame, this thing returned really on average about 2% per year. So whereas you look at just the S&P 500, zero was your hero, you could average that out and say 2% was far better than zero in that case as well.
Yeah. Now remember, zero is still the floor.
Still
it
floor.
Could be, in the worst scenario, I guess you could still get zero, but you back tested this under the worst conditions. The lost decade being, in my view, in my modern time in history, that was the worst condition. So you're looking at a 2% was the worst scenario in this. This is actually, now we're starting to graduate from 0 to maybe 2.
Yeah, exactly. And again, that's because instead of just being an equity or just being a bond and an equity like the Allianz, you have an entire asset class. Now, what your clients will say is, you know what, that return doesn't look that great over 3-year periods, but you know what, you're comparing apples and oranges. We have to now, instead of comparing it to the S&P, we have to look at indices that are an asset allocation strategy versus just a pure bond or a pure S&P. So make sure that we're comparing apples to apples.
And I think some of our registered investment advisors watching this saying, look at the diversification, and there's some name droppers in here. Not just Goldman Sachs and the overall management, but you have Bloomberg in here. I mean, we're just seeing people finally come into our business and recognize the value of the hold position. I think this is where we're scoring some really big points with Wall Street.
Absolutely.
You know, walk me through this. I think we have one more thing we want to talk about on Goldman Sachs here. Financial strength.
Well, the financial strength of Western
Yes.
and Southern, it's an A+ rated company. Again, they have great renewal rates on their fixed accounts, and partnering with Goldman Sachs is a great opportunity.
Now, a lot of our advisors may not be really acquainted with Western and Southern. Do we sell any is there any other product lines that they actually use?
Yeah, they have a great SPIA. And again, because of the financial backing of of Western and Southern, you want to look at the financial strength of Western and Southern and the carrier backing that, that option. The other thing is Western Southern is the one of only 2 companies that offers that temporary life that we talked about several months ago during our SPIA, where it's a great way to fund life insurance by having a 10-year certain, but if the client passes away before the 10 years, then the payment stops. But what we see is basically income about 25% higher. So when you think about using temporary life in conjunction with ADIA, with QLAC, and trying to use a 10, 15-year temporary life and having some backup in the back, it makes for a great marriage between some guaranteed income options.
Well, really, when you think about this, we have become huge in diversification. Our options and alternatives for the client. We can really build a sophisticated model that can really answer not only the questions of allocation, but our tax ability, our deferral ability to really time this right for the best cash flow for the client.
Right.
When you're looking at Western and Southern, one last thing, I'm trying to think of Western and Southern and how did Goldman Sachs and them get together on this?
You know, it was a great marriage. Jack Marion was out at NAFA, and actually we sat down, we talked about how do we distribute a product that has the Goldman Sachs name on it. We are really happy that we're one of the few BGAs that was selected to offer this. And at the same time, it was a great marriage because Western and Southern had been looking for ways to do FIAs, and then Goldman Sachs was looking for a way, how do we get into this business? And so I think both of them kind of crossed paths at the same time.
Well, that's all the time we have for today. Remember, before moving forward with any of the ideas you hear on our show, always consult your tax advisor, legal counsel, or your broker-dealer compliance officer. Miss an episode? Just hop out to our video archives. And remember, you could be wiser as an educated advisor. I'm Steve Savant. See you tomorrow.